And we've made it to the last chapter, chapter 10. This chapter focuses on stockholders' equity. The accounting for stock sales and purchases can be complicated, but it's part of every corporation and thus important for you to understand. We'll discuss the sale of stock and other elements of equity such as retained earnings, paid-in capital, treasury stock, and dividends. We'll also revisit a few of the ratios we discussed in previous chapters and add a few new ones. And we'll end with a discussion of the stockholders' equity section of the balance sheet. The learning objectives for this chapter are listed here. The features of a corporation. We talked about some of this in the first chapter so long ago. A corporation is a separate legal entity. It exists apart from its owners, who are the stockholders. Continuous life means that if something happens to one stockholder, the company won't end. And transferability of ownership means I can sell my stock to anyone at any time, even to Maverick. Limited liability means the stockholders are not responsible for the corporation's debts. Separation of ownership and management means that the stockholders are not in charge of managing the business. They elect a board of directors to do that. Corporate taxation. Corporations pay taxes on their earnings at a different rate than individuals pay. And government regulation. There are a lot of laws that govern how corporations can do business. This slide shows the advantages and disadvantages of a corporation. Most of this we covered in chapter 1. Some of this we just talked about. Oops. Corporations are created when the organizers obtain a charter from the state which authorizes them to sell a certain number of shares. This is usually a huge number, so they don't have to go back and ask to revise it later. They pay fees, sign the charter, file documents, and agree to a set of bylaws, and then they're ready to go. This slide shows the structure of a corporation. Stockholders elect the board of directors, which elects the chairperson, the chief executive officer, you've heard CEO, and the president, the chief operating officer. COO always makes me giggle. And they lead all of these. Sometimes there's a lot of them. And they manage the day-to-day operations. A corporation is owned by the stockholders. So what rights do they have? What do they get for buying stock in a corporation? First, they get the right to vote on anything that the board brings before them. They also get to share in dividends if there are any. That's the main reason most people buy stocks, honestly. If the company is liquidated, they get to share in any assets. And the last one, preemption, comes into play when a company does a stock split and a few other things. We'll discuss this later in the chapter. Stockholders' equity is divided into two main parts. It represents the stockholders' ownership interest in the company and consists of paid-in capital, which is also called contributed capital, and this is the amount of equity the stockholders have contributed to the company. The second part is retained earnings, which is what the company has earned through operations. Companies used to issue stock certificates to anyone buying a share of stock. This rarely happens anymore. It's all done electronically. This is what a stock certificate would look like if one were issued. Actually, I think they still do issue certificates. A lot of companies, I know my sister had lost one and was having a panic attack trying to find it. There are different types of stock. These are the most common. See what I did there? All companies that issue stock issue common stock. It's the most basic form. Some companies also issue preferred stock, which has some advantages over the commoners. We'll go into more detail in the next slides. Warning, Maverick is on a squirrel hunt right now. We're running through the house. This slide compares common stock and preferred. The last column is referring to bonds, which is more long-term debt than ownership in the company. Stock can either be par value or no par because it has to be more complicated. Par value is an amount, usually really small, that the company assigns when the stock is first issued. Legal capital is defined as the amount of assets that shareholders are required to contribute to a corporation by law. In other words, many states have laws that require shareholders to invest a minimum amount of assets in the company at all times. No par stock was not assigned a value. This is rare, and normally when it's sold, that becomes the par value. How do we account for the issuance, which means the selling of, by the way, issuance of stock? This example shows Home Depot issuing $100 million worth of stock that has a par value equal to the issue price of $10. The journal entry is simply a debit to cash for the cash received, $100 million, and a credit to common stock. But that would be too easy. In this example, the par value of that same stock is a nickel. Bit of a difference there, $9.50 on each share. How do we record this? Again, debit cash for the cash received. Credit common stock for the par value. 100 million shares times a nickel is $500,000. The difference goes to an equity account called paid-in capital. It's also called paid-in capital in excess of par, or you may see it abbreviated as PIC, in excess of par. The balance sheet after that transaction, assuming it was the only stock transaction, looks like this. There will be no gain or loss because the company is selling to people who are now stockholders. If the stock has no par listed, the selling price becomes the par value on issuance. The journal entry here is shown for Krispy Kreme. Debit cash always for the cash received. Credit the common stock account for the same amount. This shows the balance sheet after that transaction. Sometimes a company will accept something other than cash in exchange for stock. In this example, they received equipment and a building. They would record these assets at market value and credit common stock for the total. Because the par value was only $1, the excess goes to paid-in capital. In this example, the company paid an attorney with stock. The journal entry would be a debit to legal expense, and the credit would be to stock and paid-in capital. This example is software exchange for stock. The asset must be recorded at fair market value, so they debit the asset and credit the stock as usual. That's some software worth $500,000. This example of a balance sheet asks, would you invest in this company? I don't think there's any software worth that much, so my answer would be no. If that's their only asset, no.